Okay, we might get things started. And thanks for those who've joined, and hello and welcome everyone to the first in our series of PKF Digital webinars. When we launched PKF Digital, we made a commitment to providing client managers with knowledge and tools to help build confidence in opening up conversations with your clients about how they can use technology to grow their businesses and to navigate this thing that we loosely term digital transformation. You guys no doubt are experts in your field, and while it's never expected or envisaged that you need to be experts in technology, it is vitally important that you're able to see the signs and be comfortable to ask questions that can direct your client's attention to how technology might be able to solve some of the business problems that they're facing. We need to be able to do this because it's only when we can engage in these conversations that we can point them in the right direction. In fact, our clients are growing to expect that we can help them find the answers to the challenges that are stopping or inhibiting growth. And unless we're able to deliver, there is a real risk that we could lose them to firms that do. The format of these webinars has been developed in consultation with PKF partners and client managers to deliver a couple of things. Thought leadership on some of the industry fundamentals that might be impacting some of your clients. Ideas and tools that are going to help you to raise client awareness about technology, digital transformation, how it can help them. A little bit of knowledge about how NetSuite ERP works so that you have some context. And some evidence that problems like the ones that you might be thinking about can be solved and have been solved. Delivering today's content, I'm joined by Paul from PKF Digital in Perth, and by Dale, who's our Oracle NetSuite channel manager attached to the PKF Digital team in Sydney. The session's going to be quite pacey. There's going to be a lot of content. We do encourage you guys to write any questions or comments in the Q&A box as we go. We probably won't have time to answer them on the fly, but we will get back to you. I'd like to say on behalf of PKF Digital team, also a big thank you to Sarah and Jamea for their help in pulling these seminars together. This is the first, as I've mentioned, and we want your feedback. We want them to get better. We want them to be more relevant. So we really are encouraging you to let us know how you feel about how the content was delivered, how the content could be improved, so we can make sure moving forward that we can continue to improve. Whether you're joining with a particular client problem in mind or just out of curiosity, we trust you'll enjoy and you'll find the session informative and insightful. So today's agenda. Today we're going to be talking about organisations that are characterised as what we call wholesale distribution businesses. We'll describe the type of business this model, or the type of business model this represents, type of macro trends that we're seeing that impact those types of businesses, and what those businesses are doing in order to respond to those trends. We're going to then turn our minds to what limitations might be holding them back from responding to those trends. And from there, we'll share some product knowledge to explain the technology that can overcome some of these limitations in the context of an ERP or an enterprise resource planning system or an accounting system. There are ample case studies about wholesale distribution businesses that have used ERPs like NetSuite to harness the power of tech to solve these business challenges. And we'll share with you a case study from an organisation, an Australian-based business called Global Surf Industries, who is a major distributor in 63 countries of surfing gear. So on to the next slide. Let's talk about wholesale distributors. So when we tend to think about our clients in terms of the industry vertical that they play in, like they're a fashion business, they're pharma, they're building construction, or maybe financial services. When we talk about technology, digital transformation, and solving those problems, we encourage you guys to think about also the type of business model, as well as the industry vertical they sit in. So put simply, a wholesale distribution business is a type of business model where the primary activity is buying goods in bulk, selling goods typically to other businesses through a distribution or a channel play. They tend to operate in the business-to-business space, although that is changing, as you'll see as we move on. They sometimes have elements of manufacturing, typically quite light, but normally the value-added activities tend to be limited to this idea of what we call kit assembly, where they might be putting certain componentry together. They'll often be heavily dependent on secure supply of many disparate types of inventory from a range of origins, either locally or overseas, and potentially differentiated by the level and types of services they provide their business clients, linked closely with the sourcing and delivery of that product. So an example of a wholesale distribution business might be a supplier of electrical componentry and finished items to tradies, hardware stores, and other electrical equipment installers. As these types of businesses grow, they typically expand their inventory offering, and from that, their revenue stream. So inventory tracking and warehouse management become key activities and are key drivers of profitability. Inventory asset values tend to be high, supplier and client payment terms dominate negotiations, and working capital plays a critical part in financial health. So other key characteristics include significant buying activities, fairly low value add of the goods they buy, forcing to operate on very small margins, and nurturing and building large and complex, consistent client relationships to drive year-on-year growth. So with that in mind, I'm going to pass over now to Dale to talk to some of the key insights that we're seeing that are impacting this particular business model. Dale.
Excellent. Thank you very much, Mike. Great to be here, everyone. So looking at the industry insights slide in the top left-hand quadrant, we've got the top 3 KPIs for wholesale distribution companies. And these are customer service responsiveness, e-commerce growth, and inventory turnover. So let's delve a little bit deeper into each of those. Customer service responsiveness. As the wholesale industry changes and becomes more competitive, businesses can differentiate themselves by providing a superior customer experience. More and more, WD companies are realizing the importance of customer experience and the impact that this is having on repeat purchase behavior. A quicker response time to customer questions, issues, and concerns with easy-to-access agents and a clear communication channel can help businesses build a good reputation in this area. Number 2 on the list is e-commerce growth. And distributors are experiencing a major shift in the standards for B2B purchasing. More companies are purchasing goods via multiple channels rather than from a dedicated distributor. Buyers are accustomed to having detailed information available online at the time of making their purchase decision, including availability and delivery time. To meet these expectations, distributors are expected to provide competitive e-commerce websites. E-commerce growth indicates how well the distribution company is adapting to its changing purchasing environment and the rate at which the online business is growing. At number 3, we've got inventory turnover. Inventory turnover reveals how fast products are moving out of the warehouse and creating cash flow. Inventory turnover for wholesalers is a difficult balance. On the one hand, an increase in turnover can result in the company receiving cash more often, but it can also result in larger carrying costs. On the other hand, just-in-time inventory is a strategy to reduce carrying costs, but it can be difficult to achieve unless demand is well-defined and predictable. Identifying the optimal inventory turnover depends on the gross margin of items being sold and the types of items for sale and seasonality. Okay, let's move over to the top right-hand quadrant and look into the disintermediation of retailers. So measures such as physical distancing and lockdowns during the past 2 years have accelerated this trend as wholesale distributors and manufacturers realize that they can no longer rely on their usual traditional sales channels, for example, trade shows. Data shows that during lockdowns in the Asia-Pacific region, 90% of B2B sales moved online, and it's believed that 93% of businesses are likely to sustain these changes to their sales models. Apart from opening up new sales channels, WD businesses are also finding ways to manage their business online, connect with customers, and improve operations to support business continuity. 96% of businesses across JPAC and Asia Pacific shifted their go-to model in response to the pandemic. And now they need to sustain a continuing focus on e-commerce for B2B buyers and for direct-to-consumer sales, which introduces additional complexity. The third trend we're observing in the industry is supply chain disruption. This is another trend that was exacerbated by the pandemic. In Australia, our government had already begun planning a way to reduce over-reliance on our largest international trading partners. But the supply side shocks observed have been a sobering wake-up call after 30 years of smooth, global supply chain management. Building resilience requires establishing relationships with multiple suppliers and manufacturers. It also requires complete visibility into the source of each component that goes into the goods for sale, and the path that those components take to the distribution facility. That's where traceability comes in. A company must be able to track a product as it evolves from raw material to manufactured goods and then is shipped to a store or consumer. Finally, in the bottom right-hand corner, we're seeing narrowing profit margins. Over the past 10 to 15 years, there has been a wave of mergers and acquisitions in the WD market, which has driven a move to consolidation. Generally speaking, the WD industry is made up of small companies that distribute a very specific category of products to niche customers. Fragmentation like this typically lends itself to consolidation over time. Acquisitions can offer a faster way for buyers to expand their customer base, and the acquirer may also get to knock out a competitor and offer products in adjacent categories. These larger businesses are able to leverage economies of scale and offer a better selection and price, while also improving the overall customer experience. When these forces combine with things like rising costs, especially in fuel and logistics, we see an erosion of gross margins over time. I'll now hand over to Paul to talk about how businesses are responding to these trends.
Thanks, Dale. So firstly, when it comes to business drivers, a lot of wholesale distribution companies are needing to diversify into new channels. So the theme of the pandemic, I mean, it's never been more evident than during the pandemic than the last 2 years. If you weren't able to have an online buying experience, your business was in trouble. So you need to understand that are your wholesale distribution businesses commerce ready? Can your customers interact and procure from a business's website? Every industry is being disrupted by rapid changes in technology, which is bringing what we call an omni-channel experience to the mainstream. So from a customer's perspective, whether it's B2B or B2C, consumers, and we're all consumers, we expect a few things now: faster, more convenient buying processes, the ability to engage with suppliers from everywhere, the ease of product and price comparison, and now there's a whole bunch of new payment models like PayPal and Afterpay. So our website does need to allow for these new ways of being able to procure, not just how you search for it, but how you actually transact. From a business owner's perspective, the benefits are real. So the lower costs, sometimes there might be a need for a physical location. Well, with a web store, you don't need a physical location at all. You can collect customer data a lot easier. You can actually expand your customer base. Of course, 24/7, it's always open. You can purchase in the middle of the night, and it's easy to scale. So it goes without saying that there aren't many clothing retailers out there or clothing suppliers out there that do not allow customers to buy online. Switching to supply chain management, we're seeing it around the world now. The supply chains are being stretched. There's a risk around businesses not being able to get the stock that they need. So when you're managing supply chain risk, there needs to be a few considerations. So is your wholesale distribution business relying on a single supplier or a single country for certain goods? Do you have visibility into the source of each component that goes into making these goods? Businesses need to consider the cost-benefit analysis when they're looking at the supply chain risk. There needs to be big consideration around for businesses moving pieces of their supply chain back to local countries or regions, and this is known as onshoring. Onshoring benefits are pretty clear when you think about it. Although the actual product might cost a tiny bit more, there are lower transport costs, reduced tariffs and taxes, increased flexibility due to shorter lead times, and greater transparency for end-to-end tracking. So an easy one to think of with this situation is during the pandemic when face masks and sanitizer ran out from your chemist, because you'd imagine that the distributor supplying those chemists was buying from one place, maybe in China or somewhere in Asia. Maybe if they had other supply chain providers that manufactured these things in Australia, the prices wouldn't go up and they'd be able to supply the customers a little bit better. Moving to inventory management, maintaining the right levels of inventory can have a big impact on the bottom line, customer satisfaction and overall business success. With supply chains and customer demands changing rapidly, it can be hard to accurately forecast the right amount of inventory. If you run out of products to sell, of course, you lose sales and you might lose customer integrity. Conversely, over-ordering to avoid stockouts drives up storage costs and leads to excess or obsolete inventory. Many businesses struggle with holding the right amount of inventory at any given time due to manual inventory management processes and a lack of accurate forecasting. Getting forecasting right requires a complex mix of statistical and mathematical data analysis experience with the business and customer insights. To solve for this, businesses require what we call demand planning. So this is the practice of using data from both past and upcoming events to predict the amount of inventory needed to meet future demand. Accurate forecasting ensures businesses have enough product to fulfill customer orders without spending too much on inventory. Thanks. Back to you, Doug.
Excellent. Thanks for that, Paul. That was some great insight into the key areas WD businesses are focusing on. We're now going to take a deeper dive into the common challenges they face. The first challenge that we've got on the screen here is poor understanding of margins. Because they operate on low margins, WDs need to understand the true cost of their goods. So ways to do this include accounting for the inbound shipping costs of their goods or componentry upon receipt to calculate landed cost, and including labor for any assembly or light manufacturing required to produce the goods. This type of real-time visibility into true cost can inform decision-making and result in increased profitability by prioritizing sales of higher margin products, for example. Another way margins are declining is an unintended consequence of the explosive growth in e-commerce. Returns. There's a direct correlation between online sale volumes and returns, with some stats showing an average return rate of 30%, but that can get as high as 50% for apparel brands. This is much higher than the 8 to 10% return rate for in-store purchases. Now, there are a number of strategies that can be implemented to recoup revenue on returns, but the amount varies widely depending on the product, price, margin, and seasonality. Determining the best option requires accurate real-time data and analysis, usually by the finance team. Finally, with scale and complexity comes the need for service and support. Ways to drive customers to self-serve, like a B2B portal, for example, help to widen those profit margins over time. The second major challenge that we'll talk about now is suboptimal inventory management. So Paul's already spoken about how maintaining the right levels of inventory can have a big impact on the bottom line and the overall success of the business, but it can be a daunting task. The top three challenges included are stockouts, obsolete inventory, and high inventory carrying costs. Now let's look at each of those in more detail. First of all, stockouts. If you run out of product to sell, you lose out on sales. And stockouts of a popular item, when they're most wanted, forces customers to wait longer for orders. This can hurt the overall lifetime value of that customer, while internal processes and staff productivity can also suffer. Prioritizing every product against how important it could be to a customer and how important that customer is to the business and the cost of stocking that item can help you manage that risk. Obsolete inventory. Excess or dead inventory is stock a business doesn't believe it can sell due to lack of demand. As much as 20 to 30% of a business's inventory may be obsolete at any time, and some of these goods may be written off as losses, That's a big number. The most common causes are inaccurate forecasting, defective inventory management systems, poor product quality or design, and sloppy purchasing or inaccurate lead times. If a business is operating on incomplete or inaccurate inventory data, it may be acting on estimates rather than verifiable information. The harsh reality is that businesses waste a lot of money on obsolete stock, and while writing off small amounts of inventory is often unavoidable, an accurate inventory management system that generates trustworthy forecasts can help to reduce obsolete inventory and minimize write-offs. Finally, high inventory carrying costs. It might be tempting to order extra inventory to avoid running out, but overstocking can increase carrying costs and hurt the bottom line. Carrying costs arise from keeping products shelved at a warehouse, distribution center, or store, and include storage, labor, transportation, handling, insurance, taxes, item replacement, shrinkage, and depreciation. These costs can be 20 to 30% of the total inventory value, and that number increases the longer that the products are held. Carrying excess inventory can also mean that companies miss out on unknown opportunity costs by tying up storage space and excessive resources. Investing in an accurate inventory management solution is the most effective way to reduce carrying costs because they help companies avoid overstocking and find the optimal amount of inventory. The visibility delivered empowers purchasing, operations, and other supply chain staff to make better decisions by establishing more consistent receiving, put away, and fulfillment processes, and it enables them to trace every item that they're responsible for. Finally, the third challenge that we're going to have a brief look at is disparate systems, which can cause a myriad of problems for businesses. Many companies, particularly new business owners, fall into an unforeseen trap by accumulating a hairball of disparate systems to run the business, and that hairball actually ends up creating blockages and slowing things down. As software and systems are added to manage teams, automate processes, and provide insights into operations, the result can be costly, loosely connected systems with brittle integrations. It starts off simply. A business has a need that needs to be answered, and then another, and so on. They buy an accounting software to track expenses, then add a CRM to handle customers, plus inventory management. The cost and management time overhead involved in getting lots of different software starts to add up. They get a sales and operations planning solution to analyze sales. The accounting software needs another plugin to handle customer support. They're using Excel, so they get a quality management system that needs integration. Soon, the business system's hairball is growing. They implement a software to help with warranty management. Sales want a separate cloud-based commissions tracking system. Marketing gets different e-commerce and automation packages. The ops team want to manage projects and jobs, and a reporting tool is purchased to run across financials and operations. The hairball is now firmly in place and is causing havoc. Integrations are complex, they keep breaking, and they take time to fix. Applications have their own life cycles and product directions. Workarounds are error-prone. Inventory, expenses, contracts, customers, projects, works in progress, they're all harder to keep track of. There is no adequate reporting. It takes a long time and it's unreliable. The truth is not out there anymore. What happened? Why did it happen? Who was involved? These are all signs that a business might be able to benefit from a review with our digital team.
Thanks, Dale. So we've gone over the KPIs, the drivers, the issues. So I guess now it's time to maybe have a bit of reflection and think about the customers that we have. So do we have any customers that fit a wholesale distributor? You might think about what products they sell, not they fit like what market they fit into. Have you heard of them talking about declining margins? Do they have trouble making decisions or drawing insight from the data? Because as Dale pointed out, it can be everywhere. Do they have inventory problems like stockouts or holding obsolete or excessive inventory? They might have had a few during the pandemic, but hopefully they're getting back on top of it. But if these questions come up, like it could be serious issues. And are they seeking to expand or grow their business, which I hope all businesses have that on the agenda. So next slide, please, Dale. So I guess once we actually have an understanding of these businesses and where they are, what problems they might have. Probably think about how we actually start the conversation, get them talking about, how to make things a little bit easier. So are they thinking about selling through new channels? Do they have a web store? If yes, what sort of channels? Are they opening up new stores? Is it retail? Once again, is it a web store? And how could decision making be improved if they had better access to data, or do they have access to data at all? Any customer facing issues linked to fulfilling orders and inventory management, and ultimately, are their customers satisfied? Thanks.
Thanks for those conversation starters, Paul. Now we're going to do something that's probably a little bit unconventional. We're putting the cart before the horse a little bit. We thought we'd lift up the hood so you can get an idea about what a typical solution mix might look like for a WD client. I'd like to be clear that usually solution design happens after we've understood more about the particular problems and challenges that your client might be facing. But this is just to give you an idea. At the core of the solution is the general ledger with segments and budgeting. AR and AP come as standard. CRM and customer support are also included. However, wholesale distribution editions include inventory management, and demand planning is optional. In fact, all the gray boxes are modules that can be added at a later stage. This modular approach means that we're able to deliver a minimum viable product quickly, which reduces the time to value for your client. All of this is underpinned by the ability to manage multiple subsidiaries, currencies, and tax rules, and the platform can scale as the business grows and its needs evolve. Okay, now we're just going to take a really quick look at some of the assets that we have access to. These are made up of white papers, ebooks, and other thought leadership articles, as well as case studies about customers who have beaten a path through the same forest before. For example, on screen here, we have how to pick an inventory management solution that positions your business for success. This is full of useful information that help clients during their evaluation. There is also a NetSuite YouTube channel with a host of videos that cover success stories and showcase product functionality. The benchmark improvement statements that you can see on the screen are real-life examples of improvements that WD clients have reported after going live with NetSuite. There are 29,000 customers globally that are live on NetSuite at the moment, and many of them are reference sites or have published customer success stories. Now, we were planning on taking a look at the global surf industry's success story video, but we're running pretty tight on time. So we might send that around later as a follow-up email. Just so you know, Michael was right. That's an Australian success story. They were a homegrown business started in Manly Beach, and they grew their business internationally using NetSuite's global finance and operational platform. So we'll send around the video later. One more item that we'd like to cover off is our end of financial year promo. Do you have any clients with finance and operations teams of less than 10 people? If they're in the wholesale distribution vertical and fulfilling orders from multiple locations, then please feel free to talk to us. We have approval to offer an additional discount to PKF clients who sign up before the end of the financial year. This brings the cost of licensing down to $15,000 a year, and the cost of implementation should be around the same. All right, Mike, I'll hand over to you to wrap up.
Thanks, Dale. I guess the point we're making with the last slide in particular is that if you've got clients that are struggling with things that we've talked about, like managing inventory, can't track or improve their margin, they've got a lack of visibility over the various activities and operations. These are problems that can be solved for relatively modest costs. It's not big bucks. So to round it all out, in summary, we've explored the key characteristics of these wholesale distribution businesses. We've had an opportunity to reflect on the types of trends that are impacting them. So if you reflect that back on your customers, on your clients, and who fits that mold, do some of those things resonate? And are there some questions in this content that are conversation starters that you can pick up on and drive? Finally, we're keen to make sure these sessions are relevant, as I said before. So we are keen for your feedback. You will receive a follow-up email. You'll get the case study. You'll get a copy of the presentation. You'll get a copy of the recording, and also a link to the seminar, to the survey. So we'd really appreciate if you can give 5 minutes just to help us understand how we can make these sessions better. Other than that, I'd like to thank you all again for your participation. and wish you all the best. Thank you.